between investing in stocks or shares at the Nairobi Securities Exchange and investing in real estate, which of those two is the best investment option for a first-time investor? And for these, we have some assumptions. The first assumption is that you have worked very hard for the past 10 years at your job, and you've been able to save 2 million Kenya shillings. And with that 2 million, you are looking to do your first ever investment, and you are split to decide between investing in shares or stocks and investing in real estate. In addition to that, the second assumption, you are very busy. You are a busy professional. You have approached midpoint in your career. You have busy things going on at your workplace, and also you are building your young family. So you desire to have time and passive income. Having laid down that particular assumption, we're going to work with that persona across this 10-pointer framework, which I've developed for us to be able to look at all these points objectively and then decide for this persona we've said, which of the two is the best investment option for them, shares or stocks or real estate. You are all much welcomed to my channel. My name is Afagza Sifuna. I am a finance expert and qualified accountant. I'm bringing you amazing videos on making money and investing each and every day. If you like this kind of videos I'm making, down there there's a button called subscribe. Click on it to subscribe to join my channel so that you don't miss out on any of these amazing videos I'm creating for you each and every day. Thank you for subscribing and also liking this video. Having said that, let's dig right in it for you to be able to understand which of these two options is ideal for you. And the first parameter we are using to analyze is accessibility of the investment and the required startup capital. You see, when you are investing at the Nairobi Securities Exchange, the capital need is low. Even with 5,000, 10K, whichever little amount of money, you can jump at investing in the stock market, because even we have shares out there which are priced in single digits. That tells you the barrier to entry when it comes to cost is quite low at the Nairobi Securities Exchange in case you want to purchase stocks. And secondly, accessibility is easy. You just gonna need to have a CDS account, and then you're gonna be on way to investing at the NSE, whether you are investing independently or investing through stockbrokers. Okay, that is how easy it is when it comes to you investing at the NSE. You can start and immediately begin diversifying, basically spreading your risk across the different available assets at the NSE. Now, when you take a look at real estate with 2 million Kenya shillings, when we are talking about accessibility, first and foremost, that amount of money, chances are it won't buy you any legit piece of land within Nairobi City. Maybe at the peripheries, you could get at the metropolitans. Think about maybe outskirts of Kitengela. Think about outskirts of maybe Rongai, outskirts of maybe Kiambu County. You could get. But even for a prime piece of land, most likely that's just a deposit. And in case that's your entire saving, if you put that down on deposit, it's gonna mean you either need to get a loan for you to be able to clear the balance of that particular piece of land you've acquired, or even you need to get into debts which you're gonna struggle to pay. So in terms of accessibility and startup capital, clearly investing in stocks or shares win compared to investing in real estate. And please note, we are working with the assumption. I'm not assuming you are a billionaire. We already laid down the assumption the person only has 2 million and they are a working professional, meaning they need to continue working for them to be able to amass money, okay? So on the first category, the stocks or shares carry the day. And then the second parameter we are looking at is our investment horizon. Basically, the potential to build wealth over the next 20 years. What is the potential in the stock market or at the NSE specifically versus investing in real estate? At the NSE, the potential is there, and the potential is in two folds. First and foremost, there is share price appreciation, whereby the price you bought the share maybe today, years later, the share price is going to have increased substantially. Therefore, the difference is what is share price appreciation. And then the second way is through dividends. Mature companies listed at the NSE, a good chunk of them do pay their investors, they do pay investors dividends annually. And the dividend varies, but on average it's somewhere about 6-7%, with some of these stocks out there like BAT, Standard Bank, KCB, EABL having even upwards of 7-8%. Meaning, if you have invested in the stock market, you consistently, even assuming you're getting a dividend payout of 8-10%, and you constantly plow back, in 20 years, you're going to have tens of millions because of something called compounding. The benefits of compounding are going to ensure you'll have increased your investment substantially. Now let's look at investing in the real estate. If you invest in the real estate, also real estate has upside potential. And the potential in real estate is that once you have your property ready, you might be able to enjoy rental income, okay? And whether you have the property ready or not, real estate tends to appreciate. Whether it is land or land together with building, okay? They tend to appreciate. Therefore, you're going to be able to also become rich due to appreciation of real estate. And then the last bonus for real estate is that it also have leveraging opportunity. Basically, you could use your real estate as collateral in case you want to get financing for either expansion or whichever alternative investment out there. Comparing the two, I can say they're somewhat equal because both these asset classes value the opportunity to be able to grow your wealth exponentially in a 20-year time horizon. And then the third category, passive income. Remember I told you the persona we are looking at is a very busy working professional, meaning most of their full-time time is taken up by their employer as they are out there hustling, trying to get the next batch of money for them to invest. So passive income is something of importance to them. Let's compare both stock market and real estate. Stock market has opportunity of passive income right from the onset because when you invest, you are required to do nothing else. The market is going to be able to propel your investment through either investor sentiments, which is going to see that particular stock appreciate, you enjoying share price appreciation. And even out there's company management working very hard to ensure they are able to scale up shareholders' value. And that is why companies do pay dividends. So once you invest, your money is going to start working for you immediately. Okay? Now, let's look at real estate. Real estate with that 2 million Kenya shillings. First and foremost, you're going to really have to put in some work for you to be able to ensure your real estate is converting into either paying you, either it is the amount you've leased out your land at, or even so, it is rental income. And it doesn't end there. You are required to be active. Think about tenants calling you over issues, okay? Think about you dealing with repairs. You dealing with vacant units which you're supposed to source new tenants. Basically, real estate, from the look of it, is passive, but it isn't passive per se. And more so if you are starting out, it means most likely you are also the one managing your property as you are starting to rake in money from real estate. That is going to tell you you need to work extremely hard to at least get your money up fast before even you think about property management. And that is why on this point of passive income, investing in stocks carries the day. The fourth category we are looking at is liquidity. At the end of the day, adults out here need cash. Even if they say they have already planned for their cash through other mechanisms, sometimes emergencies happen, which even might force an adult to see how they can get cash from their investment. And that is why, even as we are investing out here, we need to think also partly about liquidity. And so between these two asset classes, right, which avails more liquidity? Let's look at this objectively. Looking at the stock market, when you invest at the Nairobi Securities Exchange, you bought stocks or shares, you are able to dispose them off immediately. Remember, there is a bunch of sellers and buyers, depending on individual interests, who are ready to take whichever action to either go long or go short in the market. So if you are aiming to go short, be sure you will be able to get a buyer. Basically put, you can be able to flip or exchange your shares and sell them same day. Okay? Let's now look at real estate. Assuming you have land, assuming you've built maybe rental units, you've even built units which you are selling, properties, houses, not even rentals, and you have an emergency which you need to get money instantly. Can you be able to get money from real estate immediately? The answer is no. And that's so because the purchase of real estate, most people consider it a very deep decision to make. And it takes even months for someone to decide to buy, and even for a seller to be able to dispose their property, whether it is a house, it is land, you name it. So on this point on liquidity, investing in stocks or shares carry the day. And then let's look at the fifth category, diversification. In any investing, diversification is important because it really assists you spread out your risks. Okay? So between investing in stocks or shares versus investing in real estate, which of those two avails you the ideal opportunity for you to diversify? You see, when you get into the stock market, or in this context, Nairobi Securities Exchange, you are free to partake or jump on whichever security there. You are not restricted. Of course, there are barriers based on capital requirements, based on shares which are there at the Nairobi Securities Exchange, based on transaction fees, you name it. But then you can begin diversifying immediately. NSE, when you look at the shares or stocks, it has 13 sectors. You can jump in and right away buy shares or stocks from 5 sectors. Because with 2 million Kenyan shillings, that is even more than enough for you to even decide to acquire most of the sectors at the NSE, right? Now when you look at real estate, with 2 million, it's going to mean that's going to be your first property. And if you are working full-time, employment is your main source of income, chances are you won't be able to unlock additional income because you're either going to be working very hard to save for several years, or secondly, you're going to be in debts from developing the real estate property which you acquired. And you having one property at one location, in case anything happens, chances are you're going to lose your entire investment. I'm not saying something bad is going to happen, but looking at it objectively, when you look at real estate, you have one property versus in the securities exchange, you spreading risk across multiple different sectors and also shares. The potential for diversifying immediately and even as a going concern is very high in investing in stocks. And also on that parameter, investing in stocks carries the day. And then the sixth parameter I want us to look at is time and stress. You are a busy adult, okay? You're putting your money down on a given investment. Already, you are constrained of time management. From you working full-time, having a young family, dealing with different moving pieces. So, you'd want something that doesn't add to your stress. So when we compare between investing in stocks and investing in real estate, which of those two allows you to continue managing your time optimally and also doesn't come with loss of stress? When you are investing in the securities exchange, buying stocks or shares, You buy, you hold, you wait. It's easy to decide what time you're gonna sell, okay? If you want to hold for the long term, you're gonna hold for the long term. Whichever time you decide to sell, you can sell easily. Thus, the issue around stress and time management is, of course, minimum on the stock market, okay? Because you buy, you hold. Now, when it comes to real estate, guys, remember, you have tenants, you have repairs you need to deal with, okay? You have fees, you have insurance. All those things are going to require your time in one way or another. And for you to have a good performing property, you can't neglect them. Thus, it means you're going to really need to exert yourself to ensure you unlock time for you to be able to optimally manage your real estate property. And additionally, also it's going to bring you some stress. Imagine you just arrive back home. You want to spend time with your family. A tenant calls you. There is an issue at your property. Or even a tenant has moved out. You are looking for new tenants. All these rapid, different moving pieces have higher stress in the real estate investing compared to investing in stocks. And also for that option, investing in stocks carries the day. And then the eighth parameter I want us to look at is risk. Guys, what is the risk of investing in stocks versus the risk of investing in real estate? When you invest in stocks, don't get confused, there is a risk. You could lose your capital, and unlike lending, which is typically done within structure of financial systems, you investing in stocks is you voluntarily putting your money to the market to be affected by the forces of demand and supply and market sentiments. The share you invest in can plummet, and that is your full responsibility because you agreed to the terms of getting into the stock market. But also, the same way the stock market is volatile, there is quite a huge upside potential because also that stock you invest in can really grow over time to bring you insane share price appreciation. And if you've invested in mature companies, also you'll enjoy the benefit of dividends. So the risk versus returns, I can say, is somewhat 50-50 in the stock market. But then again, that 50-50 can be enhanced by you being a savvy investor, not reacting to emotions in the market, and you investing based on fundamentals and choosing quality stocks. You can be able to mitigate the risk to see that the probability of you gaining compared to you losing in the stock market is higher, okay? Then now, let's look at the real estate. The risk in real estate, guys, once you invest and the whole system goes, the only risk in that area are, for example, occasional vacancies, okay? And also, maybe if you've chosen property in a poor location, you're going to suffer because maybe you might not even have occupancy, you might have insecurity issues, you name it. But if you've chosen a property at a good location, you might be able to mitigate against occupancy challenges and other issues around what people are looking at. So assuming you chose property at an ideal location, the upside in real estate is also looking good when it comes to mitigating risk. And comparing the two, I'd give real estate slightly a higher bump up, assuming a person is completely risk averse, they're not risk takers. We'll give real estate an upper hand, given it has less risk, given property appreciates. The way of property price is constantly going up. It never goes down, right? Unless there's a bubble in the market. Therefore, real estate has an upper hand just slightly. And then the ninth parameter I want us to look at is compounding. Compounding is basically you investing and not cashing out returns you get. You continue plowing back returns to your investment to see that your investment grows. So between investing in stocks and investing in real estate, which of those two investments have a higher compounding capability? When you put your money in the stock market, based on how you selected your portfolio, be sure you can be able to compound real good. And even, that's why I said, in case this person puts down 2 million Kenya shillings and they observe good risk management practices, invest in quality companies, invest in companies which are paying dividends, and continue plowing back their returns into their investment, in 20 years' time, they're going to have tens of millions. Basically, the investment is going to have increased substantially. That is how the real estate, how the stock market sector is going to look like, okay? And when an investor puts money down on real estate. Also, guys, real estate has an upside potential in that you can utilize rental income to continue expanding into other real estate properties, okay? Continue growing your traction in real estate. And at some point, you might need to jump onto leverage to try and skyrocket your compounding capability. Basically, get loans, you name it. With that, the compounding capability in real estate is there, yes, but it comes with a slightly higher financial risk compared to compounding in investing in stocks. That is why on this parameter, I give stocks. And then the last parameter, which is the 10th parameter, I want us to utilize to compare is comparison when it comes to flexibility. How flexible are you when it comes to managing, handling, disposing, growing between these two options? When you invest in stocks, you have high flexibility. I said you buy, you decide when to sell. Even you can buy, okay, decide you'll sell later, forget you bought, you'll come back later to look at how the markets are performing. You can even buy, decide to again get out of the market, and come later on to reinvest again. So the flexibility in the stock market is extremely high. When you look now at the real estate, when it comes to flexibility, yes, you're going to become a landlord, yes, but then again, this is a long-term financial and operational commitment. You can't say, I'm going to stop supporting part of my property, maybe I'll come back to it later. It is your property. You can't just stop supporting it because the property is going to deteriorate. That is why the commitment in real estate is more tasking compared to commitment and flexibility in the stock market. And for that, I'm going to give investing in stocks an upper hand. Guys, we've reached the 10th comparison point for this particular persona we came up with at the start of this video. By now, you have a sense between these options which one has stood out. Because investing in stock market or investing in stocks or shares has scored 7 out of 10. Investing in real estate has surpassed or overpowered investing in stocks on 3 parameters. And with that, for this particular persona, their ideal starting point to investing might be investing in stock market as opposed to jumping in real estate based on their dynamics. Please note, I'm not using this video to say objectively and conclusively stock market is better than investing in real estate. All these asset classes are amazing investments. It just depends on your situation. And through this video, I've given you a simple framework you could utilize to be looking at different properties to decide which one is ideal for you among different asset classes. In this particular comparison and assumptions we worked with, investing in stocks seems like the ideal option for this persona. What do you think about this video? Have you found it useful? Do you think the framework I've shared with you can assist you make better informed decisions when it comes to deciding whether to invest in stocks or real estate? Comment down below. Let's continue discussing. Cheers, guys, and you all stay safe.